Okay, this is the third recording for the snow day, March 15th. Okay, so this is the second year for the company, Prime Company, 80% ownership, acquired January 1, 2000X. So the ownership is the same. We're now in December 31st, 2000X7. So the goodwill impairment happened in 2000X6. We had the land sale in 2000X5. We had the equipment sale in 2000X6. And now there's a $4,000 intercompany at the end of 2000X7. So this information is all the same. Excuse me. We have one journal entry required for the equipment sale now because you don't have to have a journal entry for the gain. You only need a journal entry for the depreciation expense. You'll still need two eliminating entries, one for the gain, which is now in retained earnings, and one for the depreciation expense. And then the intercompany, you still need one. All right. So we have the income from the subsidiary of 45, dividends from the subsidiary of 35. I think that's it. So the first thing they ask us to do is to reconcile the investment account. So the common stock outstanding is 100,000. We can pick up the retained earnings balance from the beginning retained earnings of the subsidiary. Excuse me. Oh, long day. So that's 140,000. The net income reported in 2000X7 is 45,000. The dividends reported are 35,000. So the updated retained earnings for the subsidiary are 150,000. So the owner's equity of the subsidiary, updated owner's equity, is 250,000. The parent gets 80%. So the investment account based on the owner's equity of the subsidiary at the end of the year is 200,000. So there was an upstream land sale in a prior year that had a gain of $10,000, and we get 80% of that, so that hasn't been realized, so it must be subtracted. There was a downstream equipment transfer in a prior year that had a gain of 20,000, and because it was 100%, all of that has to come out, so that's minus $20,000. The equipment has been held for 2 years, and so that has been realized, and that's being depreciated at 2,000 a year, so you get to add back 2 times 2,000. And then we had an impairment of goodwill, and that was wait a minute. Sorry, we originally had goodwill of 50,000, and we impaired 18. So the remaining goodwill is 32,000. So we have to add the excess we paid for the goodwill that hasn't been impaired, and we get 80% of that. So that's this. And when you add all that together, it gives us the investment account of 201,600, which is the same amount as we are showing on the balance sheet of the parent account. Okay, so our next step is our journal entries. So first one is the net income, and our net income reported was 45,000, and 80% of that we debit investment account 36,000, credit the income statement for 36,000. Our dividends were 35,000, and we get 80% of that, so we debit cash, credit investment account. And then we had a downstream sale of equipment, and we are amortizing that or realizing the gain on that at $2,000 a year. Because it's downstream, the parent gets 100% of that, so debit investment account, credit income from the subsidiary. Okay, again, the book value, this is coming right from the subsidiaries owners' retained earnings, beginning retained earnings and common stock. You split it 80-20. This is the way the textbook does it. So they adjust the non-controlling interest in the parent by the adjustment for the current year depreciation, and then they adjust the investment and the non-controlling interest in net assets by the prior year to get their amounts for their eliminating entries. I do it with do it within the table. Whichever way you do it, you get to the same balance sheet. So whatever you want to do is fine. So our net income goes in and gets split. Our dividend goes in and gets split. I just put the amortization in here, and it works out fine. And this gets together, and that works fine. Okay, so that's our eliminating entry. Here's our excess, so 32,000 goodwill gets split. There's no income statement activity, the balance sheet activity, so 32,000 to goodwill. Investment account is 25,600. Non-controlling interest in net assets is 64. So this is our letter B. This is the letter C of additional items that are happening. The land looks the same because it's no accumulated depreciation. The gain has moved into retained earnings. Because this is an upstream, you have to split the investment between the parent and the subsidiary. So the land needs to be written down by 10,000, and the retained earnings, or the original gain, needs to be split between the parent and the subsidiary. The upstream sale of equipment that happened in 2000X6, that gain is now sitting in retained earnings, or the investment account. Because it's upstream, it doesn't need to be split. It all goes to the investment. So we need to write the equipment up by 5,000. Because the prior year had depreciation expense, that accumulated depreciation, the 2,000 accumulated depreciation is now sitting on the subsidiaries' books. The depreciation expense rolled into the retained earnings, so decrease the 20,000 investment, the 20,000 gain to 18,000. So this portion of it is the balance sheet adjustment. This portion of it is the income statement. So the balance sheet adjustment is here. The income statement adjustment is here. So increasing the equipment, you're debiting the investment account, and you're adjusting the, and sorry, I made a math error there. That's 23. Increasing the accumulated depreciation. You'll be decreasing depreciation expense, decreasing the accumulated depreciation because it's overstated. This is to check the that you've cleared everything off of the investment and the income statement. This was the adjustment D, to take care of eliminate the intercompany receivable and payable. And when you look at the filled out worksheet, you see that the parent's income is equal to the consolidated income. The income from the subsidiary goes to 0. The parent's dividends end up being the consolidated's dividends. The parent's retained earnings end up being the consolidated's retained earnings. The investment account goes to 0. The parent, let's see, we already said that. So those are sort of the main checkpoints that you can look for to see if everything has followed through the way that it should. Okay, that looks like that's it.